Good morning and welcome to our digital business breakfast. My name is Maciej Meder. I'm a managing director of zeb in Poland, and I have the pleasure to moderate today's meeting. The title of our webinar today is What is Next for Private Banking? Lessons Learned from Mature Markets. And the trigger of this meeting, of this idea, of this title, was our recently published study on private banking in Switzerland, the world's most renowned location for private banking. For today's discussion, however, we will spare a closer look on the Swiss offshore business, but rather emphasize the onshore part and take a broader look and analyze the key trends which will shape the future of this client segment. I'm very glad to welcome today my two colleagues from the Private Banking, Asset and Wealth Management Practice Group, authors of the study and true experts in the topic, Nadine Hannemann, Senior Manager, and Axel Sarnitz, Partner and Head of the Practice Group. I'm glad that you accepted my invitation today. Good morning. Hello.
Hello, and thanks for the nice introduction, Maciej.
Hello. You're welcome. Please note that the meeting is recorded and we will publish it in a few days on our webpage. As always on our meetings, also feel free to comment, ask questions using the chat function or raise your hand function in Teams. Before we start the discussion, I would like also to ask the audience about your view on the current trends and challenges in private banking, especially in Poland. And we prepared a link, which we will share in a moment. So if you, Nadine, could share the link, I can also copy this in the chat function. And in the meantime, we will also continue with our discussion. So we have this on the screen, but also I will copy this into the chat, so you could also follow the link, and we will come back to the results a bit later on. So maybe let us start with a short overview of the situation on the global and also Swiss market in particular. And so actually, if you, Nadine and Axel, could start with a short introduction of the study on the Swiss market and share actually where the money is in the global private banking and how the Swiss market is performing.
Thanks, Maciej. Then I will take over for a minute. Just maybe a few words on the poll for everybody who just joined. If you follow the link or just type in the QR code, you will be given the choice among a couple of trends that we as zeb think are relevant in private banking, and you can select each of these trends. If you think it's relevant, you can only select a few, so it really depends on your personal choice. And then just press OK and send your proposal. And then in the course of the presentation, we will get a poll, as you can see on the left-hand side here, where we can more or less rank the perception on your trends. And if you have any questions, just write us a note in the chat and we can easily answer on that. Yeah, as Maciej said, we brought to the table essentially two things. A few dates and figures from our recently published private banking study. We published it in Q3 last year, so it's fairly new. And maybe just to explain why we selected Switzerland, we put the presentation under the name Lessons Learned from Mature Markets. And of course, we perceive Switzerland as a private banking market as a mature market. Nevertheless, we do know that Switzerland, having the particularity of being an offshore hub, with 2/3 of the assets under management coming from abroad, the lessons learned we can draw will only partly be relevant for you. That's why we dedicated only a fairly short amount of time on the data and want to spend more time on 3 topics that we selected among the trends that we perceive are more relevant for you as an onshore market. That's kind of the structure we embedded the digital breakfast into. So let me start. And as Magic said, please be free to ask questions. As I share my screen, I won't see you, but I'm pretty sure my colleagues will take care of taking all the questions.
I will address the questions if there are any, so I will pass it to you. Don't worry.
Excellent. So let's have a view on the global map at the beginning. As you know, Europe used to be a flourishing private banking market. Nowadays, things look a bit different in the world. So Europe, all in all, is a fairly old market with a stable population. And also, if you look at the segment of millionaires, or in our speech, high net worth individuals, growth is stable but not dynamic, as we can see it in, for example, Asian markets or North American markets. Now, that's kind of the frame we are in terms of demographics and in terms of wealth developments. Switzerland, as a cross-border hub, has the slight advantage that it, so to say, insources some of the dynamics that we see abroad in all the other markets, or many other markets, like Germany, Austria, and probably Poland. We have to kind of live with the dynamics as they are and face a market that is more saturated, both from the client side, but of course also from the offerer side, so from the competition. Nevertheless, if you go one step further and look a bit more granularly into the client segments that are relevant for private banking, we call them usually private banking as such, ranging from 1 to 3 million assets under management or liquid assets, wealth management 3 to 10. And especially in Switzerland, we actually particularly look also at the segment above 10 million, as this complex client segment depicts specialty in the Swiss market, so to say. So if you look at those 3 focus segments, also in Switzerland, being a bit representative here, is only a very short or a very small part of the population as such. I think if you add the number of individuals here, it's roughly 2% of the population. Nevertheless, roughly 37% of liquid assets belong to that small slice of the population. And even though that's only few people, in terms of growth, both from the asset side as well as from the individuals, it's not too bad, right? It's not in the size as we see it in the Americas or in Asia, but nevertheless, if you look at the individual growth, for example, that's roughly half the size we saw in Asia. So there is dynamic in the market, which makes it attractive as such for banking. And maybe just as a side remark, because we will briefly touch this topic later, if you look at the client segment that follows, the affluent segment, that's actually one of the trends we see as ZEB, because historically banks have either concentrated on the private banking side or the retail side and kind of forgot a bit about the segment in between, which is changing now by all kinds of players, more or less going into a hybrid private banking offering where they, so to say, combine the advantages that we've seen in retail banking with the personal nudge that we still see in private banking. So where has the dynamic come from? Especially in the last 10 years, honestly speaking, it was not so much the rigor of management teams, but it was more the rigor of the equity markets. So if you look at, for example, the liquid assets as a measure of performance in that case, you can see that in the last 10 years, especially the upper end of the client segments have seen substantial growth on their liquid assets, roughly 8%. For ultra-high net worth individuals, 4% for wealth management, roughly 4% also for private banking. And the key reason why that was the case is that a fairly large percentage of the overall investment is dedicated to equities. In Switzerland, for example, it's 46%. I think in overall Europe, it's a bit lower, something in the 30s. So the Swiss banks are especially prone to equity markets, but we have to say that has paid off. As I said, the study was published in Q3 of last year, and if you were looking at equity markets until that point, I think they increased by a factor of 3.2 over this 10-year plus time frame. So it was, I mean, a bit nice for banks to lay back and actually enjoy the performance ride. In some cases that took away a bit the focus on maybe more dedicated management action, but we actually see that coming again, and we will spend more time on that in a few minutes. So Axel, for a moment, before we actually deep dive into that, let's maybe have a look at the profitability, which I think you would like to stress a few words on.
Yes, thanks, Nadine. If you're looking on that chart just in front of all of us, you can see a comparison of the profitability of the Swiss market and the German and Austrian market. The differentiating factor between these markets is that Germany and Austria are pure onshore markets, which means no one in the world would ever come to the idea of flying into Berlin or Frankfurt to have wealth administered here in Germany. What we're talking about is German earned, German taxed, German invested money, and similar for Austria. Switzerland is different in that sense that as the renowned global offshore center, of course, as Nadine stressed, 65 to 70% of all wealth administered in Switzerland stems from offshore money, which is exactly the reason why the market is profitable and why it is substantially more profitable than the onshore markets at comparison. That means for a market such as Poland, probably your comparison would be the onshore part of Switzerland and of course Germany and Austria, which means there is a certain potential that over time margins and profitability in the market might erode, and that we need to look into solutions to come to terms with that trend, which we see in essentially each and every onshore market. You could take Denmark, you could take Sweden, you could take whatever have you, as long as it is not offshore. There is a comparable trend to these other two markets. What's the reason behind that? If you flip over to the next page, Nadine, that is very simple, that many private bankers perceive securities business as private banking. Whilst if you're in an onshore environment, we need to state that typically clients consist of much more than just their securities, which you can see here on the left-hand side, where we analyzed a few hundred financial plannings that were made in various banks across Europe to try to detect what typical wealth structures of clients are. And it does not come in as a surprise that many wealthy people are active entrepreneurs, so their own company has a huge part, of course, of their wealth. People are invested in real estate, also does not come in as a surprise. People are invested in what we call passion investment, be it art, be it sculptures, be it old timers, be it what have you, be it their boats, and also provisioning insurance, that means risk mitigation, evermore becomes a huge topic. Whilst private banking in this onshore environment is very often perceived as purely focusing on the disposable assets, securities business, which is one of the drivers why in onshore environments profitability is so low, because simply banks fail to advise what to propose and offer all the services required, which you can see on the right-hand side of this chart, and simply focus on some aspects of wealth administration which clients do perceive as important, but which are not their highest interests. And because the holistic view is lacking, clients tend to negotiate margins very hard, and that is the very reason why you do see the very poor state of the margins in onshore markets. Whilst, of course, those people coming in from foreign countries, taking their money into Switzerland, then of course security business is what you can do for them, and of course margins are much higher because you're also paying for the security of an environment such as Switzerland. So now the fields of action which we've selected are of course linked to this very status of onshore business, which you'll see in the Polish market of course as well, and hence we selected these 3 for further discussion.
Yeah, I think it would be good to start, I mean, or to mention topic of succession, yeah, because I think what is very interesting, this topic is, of course, one of the topics hot on the Polish market for the last couple of years, but would be interesting to see on the more developed markets with longer history, what challenges are banks on this market facing in terms of succession, Nadine. So if you could share your experiences, what is the situation there? I mean, is it also the topic, or it's already a topic which is not so hot anymore, and actually what it means for the banks?
Yeah, thanks, Maciek. So as in the beginning, we brought a few slides referring to Switzerland, but let's kind of have in mind that we stress the conclusions for the broader European markets and Poland in particular. So what we know from continental Europe, and that's really not an issue just faced in Switzerland, is that inheritance in absolute values is rising for the last 10 and 20 years, linearly, so to speak. But that's not it. I mean, not absolutely speaking only, but also relatively in terms of the share of disposable income that becomes disposable, not the savings actually, but actually as inheritance is growing in relevance. In Switzerland, for example, roughly 25% of the ultra high net worth individuals are claiming their wealth from inherited wealth. The figure is extremely high in Austria, with roughly 50%. It's around a third in Germany and a bit lower, usually due to entrepreneurial efforts in the US and in the UK. So no matter where exactly the figure stands, the bottom line is, I think, clear that inheritance as a source of wealth is growing in importance, which is very good news for banks, because of course, for many years you can grow the relationship to a higher and simply transfer and take on the wealth. But of course, it's also a risk. Why is it a risk? Again, bringing some data from Switzerland, we did a couple of projects with banks there and found out that industry-wide, so it's not just a particularity of those 2 banks, industry-wide, the average age of the clients in a private bank is extremely high. So in this bank A, the average was at 69 years, and in bank B, it was 71 years. And naturally, if you look at the figure, you become a bit worried about the assets under management attached. And the worry is actually correct, because roughly 3/4 of the assets under management in those 2 banks belong to people whose mortality is fairly high in statistical terms. So when we crunched the data, we found out that those 2 banks are at risk of losing roughly 4% of their assets under management annually, simply due to the age structure of their clients. Well, and that's not good news, as you can imagine. So what's the answer to that? I mean, a trivially sounding answer is that you have to build a relationship. It sounds trivial, but in reality, we found out that that's not very often actually done very well. Very typically speaking, the relationship managers very strongly focus on the relationship they currently have with the old client, the patriarch or the mother of a family, and kind of forget about the generations that are coming. And well, it is an issue because roughly 50% of hires, as we know, quit the relationship with the bank of their parents. So it is at the very heart of the interest of the bank to build a relationship that includes the hire as early as possible. And the way to do that, as we see nicely, is to actually go beyond the securities focus that most banks have, as Axel just said, and really look at the life in its completeness, starting early on. Because, of course, as you can imagine, for a person in his 20s, it's not so relevant to think about, let's say, options for retirement, but it is more relevant to think about education. It is more relevant, let's say, to think about a financing option for a startup. It is more relevant to communicate via maybe WhatsApp or a video chat instead of moving to a bank. So the demands of the life cycle change, and it makes a lot of sense to actually think about that as a bank and not just start in this section here that is on the very right-hand side. And very funnily speaking, we actually just drafted a paper on a vehicle which is called Swiss Trust. So in Switzerland, the government is just thinking about introducing an entity, a trust entity, which will, if it is allowed and regularly confirmed, allow exactly that as a bank you can address clients over generations and start very early to donate or pass on wealth and establish a relationship that goes far beyond the age groups that we currently see as average ages.
Mm-hmm. And Nadine, maybe if we could, because I think it's an interesting aspect here, because you mentioned WhatsApp. I mean, does this approach to here's, I mean, also means certain change of, I would say, distribution channels or approach to the clients, so that these younger clients are more digital affine and they will tend rather to do things digitally? I mean, do you see any kind of a shift? And second question, I mean, is it that this is should it be the same relationship manager who is covering, I would say, the father or mother of the family? I mean, there are some like tandems that there is a younger, for instance, relationship manager who is covering, I would say, that the family members and they work somehow together. I mean, can you share a bit your experience on these aspects?
Maybe let me take the second question, whether the RM is the same one, and I'll pass on the first one to Axel because I think he has a couple of cool insights to share on that. That's okay, Axel. So regarding the second question, you're absolutely right. The relationship manager of the father or mother shouldn't be the prime relationship manager for the child. Simply, for example, because of age. I mean, I'm 35 now, and if I were having a relationship manager approaching 60, there would be a hurdle in terms of simply the life priorities you would have. And so it makes a lot of sense as a bank to parallelize, so to say, the relationship model to your clients and make sure that they're speaking the same languages. I mean, when you think about young private banks or operators offering private banking options, you wouldn't see relationship manager in their 60s approaching 25-year-olds, right? And it's simply about speaking the same language, having similar interests, and speaking about them in a convincing and authentic way, just as it is for the father or the mother. So having said that, as a bank, a core lever of success, we believe, is to have a tandem model where the older relationship manager takes on his hand, so to say, the higher and the younger relationship manager, and actually allows them to build a relationship over time and create the same kind of trust that he has with his client or her client. And maybe Axel, a few words on your digital know-how regarding hires, if that's okay.
Yeah, we've just concluded a questionnaire with a couple of a few hundred customers in private banking in Central Europe. And it became very, very clear that the expectations of younger generation towards digitization are much, much higher. Younger generation in this case does not mean those who are 20 years or younger, but we're talking about those who are already in charge of managing some parts of family wealth. That's the age group of 25 to say 40 years of age. There is a wonderful use case that I like very much from Asia. It's Credit Suisse, because Credit Suisse managed to communicate with all their clients at whatever social media channels or feeds they would like to use, be it WhatsApp, which is popular in Europe only, but in Greater China, it's Tencent, it's Alibaba, so WeChat and other platforms. What Credit Suisse did was they came to agreements with all these providers of platforms to have secure communication between bank and client via these channels, because that is one of the concerns, or one of the major concerns, of course, of the wealthy clients. Now, having established secure communication channels into the environments in which the clients usually move, act, and communicate, made a huge, huge difference for the bank, because all of a sudden their level of relevance has increased dramatically. And for the clients, it's much, much easier to just drop a few short lines while they are in WeChat anyhow, instead of just picking up a phone and calling their relationship manager via landlines. So yes, it makes a huge, huge difference. And also let me stress one more aspect on digitization. Sometimes, in particular in well-established organizations, which we have plenty of in Switzerland as well, be it in other mature markets, you stumble upon the assumption that, oh, well, our clients are old, as we just stressed, and they like to come in here for coffee. Digitization is not on their agenda. Given the fact that most of these clients stem from entrepreneurial backgrounds, I do not buy into that, and it's against all our project expectations and experiences, because each of these clients has the challenge to digitize the own company as well. So whatever business they run, all of them need to answer the question how to communicate in digital ways with their clients in their company. So these people who are well confronted with digitization do not have any digital expectations towards their bank simply because they're old. It's not really a convincing argument. So in reality, it is that clients are so frustrated with many of their banks that they simply stopped asking for any digital initiatives. Gratefully take whatever they can get in digitization. So overall, we do think the topic is relevant, the topic is hot, it's relevant and hot for all of the clients. However, of course, there is a very, very special emphasis on the younger generation in Europe, and of course, the level of digitization in Asia overall is much higher.
Mm-hmm. Okay, thank you, Axel. I think this is a good introduction to our second topic, which we wanted to elaborate on. So the data analytics, because I think it's pretty clear that in retail banking, where we have a lot of clients, these methods are already being used for many years. The question is, do you know, Nadine, any nice use cases which can be also applicable to the private banking sector? And does it really make sense to use data analytics for private banking?
Give you a very short answer. I think it does make sense, or we think it does make sense. But let me give a more round answer. So when we started to think about data analytics, we found out that banks, naturally speaking, have a proneness to data. So that doesn't come as a surprise. However, in the past, data analytics a bit narrowly focused mostly on the investment side. So how to find attractive investment opportunities, how to improve alpha, how to give good advisory. In the meantime, we learned that this is really not it. Data analytics doesn't end there, but actually, fulfills its true scope by looking much broader, both on the client side, but also on the operations side. And I guess we could do a whole digital business breakfast just on data analytics. That's why we selected 2 use cases only. But I think those illustrate the point, nevertheless, that we try to make. So the one actually links to the first ideas on hires. Because if you remember, we just learned that in the 2 Swiss banks that we analyzed, their annual potential churn rate, so losses of AUM, are around 4% annually. And we actually just went into a project with a very big Italian private bank, which tries to answer the question, how much is their probability that clients, hires, will churn? So the data model that can answer that essentially answers 2 questions. The first question sounds trivial, but in reality often is not, is, are there hires? Let's say if they are children, it comes natural, but there might be a hire you as a bank have never heard of. For example, some old love in Italy, out of which a child came, and you as a bank might have never met that child. So the first question data models try to answer is, are there hires? And if there are, the second relevant question is, what is your relationship with the hire? Because if the relationship is good, the risk of churn is low. Whereas if the relationship is not sound and good, the risk of churn is fairly high. So all those predictive models are trying to do is, from a data perspective, learn whether you are at risk as a bank to lose assets under management when your old clients die. And from our learnings from the projects and our analytics department, we believe that you can actually, simply by the use of crunching data, reduce this risk of hires turning their back on you from 4% to roughly 1%. So that's more than 2/3. And if you actually transfer that on the earnings and the bottom line of a private bank, and given we did a Swiss study, we did that actually for a medium-sized traditional Swiss private bank, you can reduce the decline on earnings before interest and taxes from 14% to 5%. So it's not a winner case. You don't increase, but you actually make sure you retain assets under management, which is just as important in the years to come. That's one case I wanted to show you briefly. Another one is on pricing.
Here already we have positive case, I see.
Yeah, we do have positive cases for sure. Yeah, I mean, the story is actually very simple. In many, many private banks, I've actually not seen another one. There are exactly 2 parameters that are used to price a client. That's his or her assets under management, and it's the risk profile being transparent through the investment strategy. And as you all know in private banking, those 2 parameters by no way reflect the relationship with the bank. They don't speak about how happy the client is. They don't speak about the trust that the client has with the bank. All the relevant information for the client is left out of the pricing scheme. Now, naturally, that entails that the consumer rent in private banking is fairly large, to the disadvantage of private banks. And yeah, funny and to me incomprehensive fact, for example, is that especially in pricing, and especially in private banking, the discount rates that are used on clients are extremely high. In the sample we analyzed, they were between 25 to 50%. So optimization is fairly easy, I would say, in terms of the fruit there is fairly low hanging. What would be the best thing to do? The best thing would be to actually incorporate all the relevant sales convincing points for a client into the pricing scheme. So everything that a client actually values included. That would be the theoretically correct answer. And for a bank, meaning that you could actually increase the producer rent. But I mean, it's very simple to start way before that by simply doing the next natural steps. So look at the discount ratios and optimize those. Look at the facts every CRM system has in place. How long is the client with you? What is the net promoter score? How's the performance of the investment strategy, and so on. So at least make sure that the things you incorporate. And if you do that, as ADB, we believe that the scope in potential is between 8 to 10 basis points on assets under management by simple optimization like that, which has a huge lever on the earnings side, as you know, because pricing is simply very important on earnings, on bottom line earnings. So there are a lot of good reasons overall to finish on data analytics, to spend time thinking about data a bit more closely. And overall, for the sample of Swiss banks we analyzed, we concluded that the lever is high in both directions, both towards the earnings, but also towards the cost, but actually a bit higher on the earnings side, because there's a lot you can do. You can do a lot on pricing, but you can also do a lot on wallet optimization, which refers to the holistic picture we learned about from Axel in the beginning. The securities is one, but there's so much more. There's real estate, there are company affiliations, there's a portfolio of products a private banking client usually holds, and there were opportunities for banks to offer accordingly. And yeah, there's these opportunities with higher. So there's plenty of things to think about next to optimization of costs.
Perfect.
To put ideas in a nutshell.
Yeah, I think we could continue longer, but maybe let's slowly move to the third topic, which I think it's not so obvious, because of course there was there is still a huge hype on crypto, digital assets, etc. in, I would say, finance industry. But the key question is it really applicable to private banking, wealth management, which I would say the clients of which are typically a bit more conservative than the usual clients? So the question is, this topic, digital assets, relevant at all for private banks, Axel?
Oh, thanks, Maciej. Oh, yeah, well, to answer the question, yes, we do think it is highly relevant, and private banks should start taking care of digital assets. But first of all, let me do some explanations on what do we understand by digital assets, and you see the expression security tokens here. All this discussion is essentially based on distributed ledger technology, a technology that was introduced together with the Bitcoin, I think in 2008 it was. So we're not talking a particularly new technology anymore. However, this technology has always been linked to some extent to Bitcoin, and as you all know, the Bitcoin has been under intense discussion due to the fact that the Bitcoin is not really linked to anything in the real economy, but it is, say, a virtual construction that is kept in a shortage by technical means without being, as I just said, linked to anything in the real world. So that is, of course, what makes this construction particularly speculative. And some people say that once we do have quantum computing, it won't be secure anymore anyhow, because then computers would be powerful enough to crack it. So, of course, there is good reasons why many banks and established providers are very hesitant to jump onto cryptocurrencies. There might be some differentiations between stable coins and the classical Ethereums or Bitcoins. However, still, the essential story is the same. What makes it a hot topic, though, is that distributed ledger technology can be used to tokenize multiple assets which are currently not really available to the broad range of private banking wealthy clients, be it from arts, be it from old timers, be it from what have you. Today it's like this: either you do have $80 million to spend on whatever painting by Picasso, and then it's yours. However, you do have huge trouble with the insurance. You do have huge trouble with storage because not even banks would like to put it into their basements. And it is a have it or have it not decision, whilst it is not really an asset class for the majority, even of wealthy people. Distributed ledger technology now opens the opportunity to securitize by means of blockchain technology various of these assets and make them available to a broader private banking clientele. That means all of a sudden I can buy a share in Rembrandt, Picasso, whatever, Kandinsky in painting, and do not have much of a trouble in keeping it and in putting it into my asset allocation, etc., etc. So what you see here is cryptocurrencies to us is just the first use case to the broader range of digital, distributed ledger technology, and thereby the possibility to securitize whatever assets are currently not available. And that is what, in our opinion, makes it a very, very hot topic. Due to what I've just described is, as you have seen on the page before, we're expecting very, very dynamic growth, be it in cryptocurrencies or in the tokenization of these assets. Now, what do we see in the market? And you see here an example from the Swiss market. There is those whom we call digital asset leaders. That's only 5% of the providers. And many of these providers, to be very honest, are small, niche players, sometimes fintechs. And the only really reputable name that is in the first league of digital asset providers is Julius Baer, who've set up huge projects to make available digital assets to their clientele, because essentially each and every part of the bank is affected by the strategic decision to make access possible for your clients to these digital assets. The second position, digital asset followers, as you see here in the middle of the picture, is about 15% of the market. Most of these banks focus on custody services for digital assets. And very, very often, as I just stressed in the beginning, cryptocurrencies are seen as the first use case for custody processes, target operating model, and functionalities in the digital asset space. The majority of the market, and really the brunt majority of the market, about 80%, are very, very hesitant to follow suit. And these institutions stress the fact that essentially today we're talking cryptocurrencies. Cryptocurrencies do not have a real world meaning, and hence we should be very careful in offering something of that speculative character to our clients. And of course, if you follow on the value development of the Bitcoin over the past 5 years, which has fluctuations of 50% up, 30% down, sometimes even more, that is, of course, a position that can be understood. So what we recommend is for each and every provider to come up with a strategy on how to approach the space of digital assets. As I said, we believe it's hot, but of course it should be approached in a careful and meaningful way. What is always possible, and here private banking, wealth banking makes it easier than in retail banking, because you essentially do have a strategic asset allocation, and it's much, much easier to include some of digital assets into a sound strategic asset allocation with a fair share, instead of what some retail customers do, who just simply go and use whatever fintech applications are available, be it Coinbase, be it what have you in Europe from the fintech space, and simply buy Bitcoins and do the right, which is, in our opinion, in fact, highly speculative. Now, looking deeper into what can you do with the digital assets, as I just stressed, there is now use cases everywhere. It deeply affects the market infrastructure that you have. Of course, it also can affect balance sheet and liquidity management if you employ it in your company based on distributed ledger technology. Essentially, you can apply this technology everywhere. For private banking, of course, the first step is custody, but you can also include it in investment services, like are you willing to offer brokerage via your platform in these assets? Would you be the one who to tokenize some of the assets and be kind of a market maker or book runner for these new assets? There's some use cases already in the corporate banking space, in particular stemming from trade finance and project finance of syndicated loans, which are well advanced, and some huge European and global banks formed various consortia to make these services via blockchain technology available. And of course, you can open up trading platforms for each and every of these topics. What is, of course, striking is the huge success of providers such as Coinbase, which made a start at the New York Stock Exchange at a listing of, I think, $17 billion in their IPO, which of course shows the potential of that technology and of tokenizing whatever assets which are today not granular, which are today not tradable, and where you do have huge, sometimes hesitations, of course, in security matters such as arts being copied, arts having been stolen, arts having been stored wherever in an indecent way, which establishes high risk. Much of that can be mitigated by using tokenization and blockchain technology. And then again, you have a wide range, as you can see on page 23, to make these services available. To us, honestly speaking, we trust if a bank has a focus well on custody. It is, of course, meaningful to start with these custodian services and offer that not only to your clientele, but also to others who use your services. Second next logical step for us in private banking would be to not shy away from the topic, but actively include it in your advisory and portfolio management approaches. That is, you do have an opinion, you do maybe have some research on the topic, and you're maybe including it in the strategic asset allocation that you're offering your clients. Currently, it is like in particular in cryptocurrencies, you have a mood of a gold rush some 120 years ago in the Klondike. That is, margins are extremely high, very well paid business and very well paid services. And that, of course, is also one of the reasons why many banks think about it. First of all, it's here to stay. It's going to be a topic. Yes, there's going to be some losses. However, at this very moment, the high risk involved with it is also paid by the marketplace. Our very clear recommendation and opinion on the topic is it makes sense for each and every organization that's in the private banking space to start at least first steps dealing with the topics, doing some pilots, including it in the strategy of the bank, and deciding on where, in which area, in which space are we going to put a focus on distributed ledger technology. Again, it has IT implications, it has process implications, it has frontline implications, and hence needs to be taken care of in a more holistic way, never forgetting that each journey starts with the first step.
Okay, great. Thank you very much, Axel. It looks like it's not yet I would say, mainstream topic, but with high potential, and I think also a lot of renowned players, like the mentioned Julius Baer. I think they're already looking into the topic. Nadine, maybe we can have a look on our poll results. Can you maybe share what is hot on the agenda of our audience, and maybe if we could comment shortly on that, I guess.
Yeah, I just wanted to briefly show the QR code again for those who might have joined a bit later. So we issued a poll at the beginning. If you follow the link here or scan the QR code, you can directly get into the poll. So for everybody who hasn't seen it yet, and then I will jump over actually. Give me a second. and see what happened in the meantime. Okay, I hope you can see that well. Let me try to increase it a bit. So we pre-selected a few trends that we thought were relevant. Excuse the question marks in the end. But yeah, that's actually a quite interesting picture. So digital seems to be a key topic for you guys. Digital client journey or digital private bank more generally speaking. Succession planning. So basically our topic on hires comes second. Hybrid interaction with the client, digital interaction comes third. Data analytics fourth and ESG 5. So
and
let's
the digital assets 7, say Axel. So I think the observation that yet a lot of banks are hesitant and do not have it high on the agenda, I think was a correct one.
Yeah. Well, very interesting. I mean, the questions I would have now is what's the reason behind the polling? But I think it gives a fairly clear answer that digitization is at the core topic of the participants here. So maybe if Magic, it's okay if one or two want to say something about their preferences, because that would be interesting for us as well to learn about what's actually at your heart and you're thinking about the most.
I think that, I mean, if somebody wants to comment, needs to leave the message on the chat or raise the hand button. Click the raise the hand button, because then we have muted the mics, Nadine. So, but I think what is pretty interesting, I think, is relatively low scoring of ESG topic. I think we were also discussing prior to the meeting. I mean, shall we also put it on the agenda? It's definitely also one of the important trends. But we thought, okay, maybe, I mean, this we can also use for a dedicated meeting and into the broader context of ESG. What I'm also pretty surprised, but it's a position 1 and 3. So let's say 2 trends which are really high on the agenda. So the digital or hybrid communication. So I think this is the key to this segment, that it's not only about fully digital, but maybe about hybrid communication. And I would say succession planning, but I would say this is not a big surprise. I think this we expected pretty well, that the succession planning also, I would say, in our local circumstances is a very important element. Axel, maybe I would say, just to close, because our time is also running out, maybe if you could just comment briefly, because we have spoken about a couple of topics. What, of course, is an interesting question, to what extent we as ZTB are helping clients in these topics. So we prepared here a short selection of different project types. If you could just maybe pick up a couple of examples of your recent assignments, which you found most relevant and most interesting for today.
Yeah, thanks, Maciek. In essence, what you do see here is an overview of the topics that kept us busy over the last, say, 2, 3, 4 years in our projects, working all over Europe. The ones that you see in gray are the examples which we picked and discussed. There is, however, many more. Be it collaboration between private banking and corporate division, be it segmentation, be it client needs, be it the affluent space, be it optimization of wallet, very high on the agenda, in particular in mature markets. Pricing. What has not been so much on the agenda anymore was regulation, but it was rather business model oriented projects, which always focus on the fact how to grow, how to make more money, how to get an organization that is closely linked to the client's needs. And of course, as you can see on the right-hand side, IT as well. We do have a huge section of colleagues in our IT department, and digitization, data analytics, as we've just seen also in the survey, are very high on the agenda. So that kept us also busy. And of course, that has some links into the operations space. So whatever questions you may have in the future, don't hesitate to give us a ring. we'll hopefully be capable of answering whatever question might be on the table and support, of course.
Yeah, I think there are. I think it's also worth to mention that I would say these are the most prominent examples. So I mean, if there is anything on the list which is not here, I think also we might have experience in from other projects in this area. Okay, Nadine, Axel, thank you very much for having you today, for sharing your experience. For me, it was a very interesting discussion, also just to get inspired what is happening on the more mature markets. So once again, thank you for sharing this knowledge with all of us. Also, I would like to thank all the participants today for your presence, for listening to us. Short reminder: I mean, the presentation which we have presented today will be also shared today in the afternoon with you. So don't worry. I mean, if there are some aspects which you have seen and you found interesting, you will get the presentation. And of course, we encourage to get in contact with us if you would like to continue the discussion. We see this digital topic, digital communication, digital channels as a very hot topic. So definitely also we have experience and would like to continue discussion with you. If you missed part of the webinar today, also, I mean, we recorded it, and beginning of next week will be published on our webpage. And also feel free to share it to other people which this topic might be relevant to. So once again, thank you to you, Nadine, Axel. Thank you to participants, and I wish everybody a nice day, and looking forward to see you on our next business breakfast. Digital business breakfast, which will be in approximately 4 weeks from now. We will send out shortly the invitations. So thank you very much, and goodbye.
Thank you. And thanks a lot. Bye.
Thank you.